Terrific. I'd like to kick off the second panel discussion, please. And so I'm welcoming back to the stage Jay. He and his panel are going to be discussing how to invest in second and third markets in Florida. Welcome, Jay, and esteemed panelists.
Okay. Anytime you're in between the bar or a Hall of Fame football player, I guess we're going to have to move a little quickly here. I'd like to introduce Travis Mack with Greenwood Self-Storage, Patrick Dolezal with Ferber Company, and also David Sachs with Duane Morris. And the topic of our discussion is how to invest in second and third markets, or I'd like to say secondary and tertiary markets. And I thought we should just kick it off. Maybe we'll start with David. And if you could just give a brief who, what, where you are and what you think about this, and then we'll keep moving it.
My name is David Sachs. I am Special Counsel in Land Use, Zoning, and Development for Duane Morris. Love talking about the secondary and tertiary markets because I think there are opportunities there. Anyway, that's my intro for today. Thanks.
Okay. Travis?
My name is Travis Mack. I am the founder and fund manager for the Greenwood Self-Storage Fund. We are a fund that is putting about 20 to 25 assets together in the self-storage vertical. I love self-storages. Everyone should say that together. And we are implement a value-add strategy in those secondary and tertiary markets. So excited to be here, and thank you.
Excellent. Patrick?
Good morning. My name is Patrick Dolezal. I'm the Executive Vice President at the Ferber Company. We are a regional real estate developer, primarily in the retail industry, and we create 1031 exchange opportunities via credit tenant net leases.
Excellent. All right, so there's always at least in my mind, what is a secondary or a third market? Is that Doral, or is that outside of Orlando? When I think of secondary and third, it's not NFL cities, that's for sure. So why don't each of you maybe touch on that and maybe some uniquenesses of why you specialize in those areas? And we can...
I'll be happy to go first. It's just starting with secondary markets. Typically, they are adjacent to or very close to primary markets. The differences from the primary markets are one of risk, are one of how long are you going to hold the asset, and certain less amenities than, say, the city of Miami. In fact, I'm going to use the city of Miami and Miami-Dade County today, since we have Mayor Cava here, as just as a model. I don't know if the rest of you want to do that. But I think it's a good model to talk about that. But secondary markets, by and large, are adjacent to primary markets, have less of the amenities, have less of the investment, and less. Well, I'll stop there.
I think I can add a little bit to that. And so, you certainly have the primary markets, which are what we like to call the NFL cities, of course. You can kind of slice and dice this by population, by numerous different, metrics that you can utilize. So we look at it from a population perspective. We kind of consider tertiary markets, those markets that are close to MSAs, major MSAs, that might have a population of, 200,000 or 150,000. You can even get down into fourth-tier markets. Fourth-tier markets, and then after fourth-tier markets, you can either go to fifth-tier or you can call them rural markets. And so, and basically how we look at it is really by demographics and population is kind of how we slice and dice, those particular verticals.
Yeah, I would agree with all those statements. I think for us as a real retail developer, we're looking for the growth that is more of a sprawl, right? From a retail perspective, we've got the primary markets where things are starting to go vertical. You're starting to do mixed-use projects. From a secondary or tertiary market, those aren't really the projects that we're seeing or that we're doing. We're doing basic single-story retail, community-oriented developments, so we're serving the need of that growth community.
Excellent. All right, let's now drill down to kind of more what each of you more specialize in, now that we've kind of set the stage of what those markets are. So we're going to start, Patrick, with you. Now, give us an example in maybe a type, a use, and where, so people would understand, you know, what you're doing, like retail. I'm assuming some of it might be traditional retail, like drugstore or food or something, but I'll let you.
Sure. So let's go all the way out there and do a tertiary market. We just finished a deal a couple of years ago in a tertiary market, which was Okeechobee, Florida, right? Pretty far away from Miami. A little bit of growth, not a lot of growth, not a lot of density. And the reason why we went there was because of a different type of growth. We had a retail client that was interested in penetrating markets in the Central Florida corridor, Okeechobee, Belglade, Lake Wales, Winter Haven, places like that. So they brought us to the market and wanted to capture some of those dollars that were out there. We found a site, we did an assemblage, and we went in and got it approved and built for everybody that's familiar, a Wawa gas station, and worked with the community. It was a big deal for them because in some of these secondary and tertiary markets, there's not a lot of investment that's going on. So the community really thought that was a positive change for them, and we ended up selling it to a 1031 investor who was interested in long-term income and was very happy with the credit of that tenant.
Excellent. And so in a certain regard, I'm going to go bounce back to David. Using an example like that, and you can certainly use another one, obviously there's land, obviously there's zoning, obviously there's legal, adequate, all the different things that would go into what you, in your world of helping a developer or helping a landowner. Maybe you could give an example of how, because even though it's not Miami-Dade, I'm assuming they still have different requirements in the state of Florida from a zoning, adequate public facilities use.
Yes, they do. And as I mentioned a little bit earlier, I thought I would use the city of Miami, Miami-Dade County as a model. In 2009, the city of Miami passed the Miami 21 zoning code, which really transformed the city of Miami. There are now much larger skyscrapers, et cetera, but with respect to tertiary, secondary and tertiary markets, there is now an opportunity, or was an opportunity in Overtown, and now we see what's happened to Overtown. Overtown was no doubt a tertiary market, but for the fact that its proximity to the city of Miami. But whether it's population, whether all the typical factors that define secondary and tertiary markets were certainly present until responsible legislation. Sounds oxymoronic, doesn't it? Responsible legislation. But I think you heard it from Mayor Cava, responsible legislation, because one of the benefits is investment. And in the area of Alapata, which now I would consider a hot area for a number of reasons. One, I have clients looking there based upon the model of transforming what's a warehouse district into a museum campus. And this is done by the Rubel brothers, who made their money in another part very close by and have now parked their money in a warehouse district and have gone through a form of zoning called adaptive reuse, which transformed an old garden variety warehouse with zero amenities within it. It was a warehouse, and has now made it into a wonderful museum. Two museums there are actually. Two museums, a high-priced mixed use, high-priced dining, high-priced lunch. It is an area absolutely transformed by what? Responsible legislation, leadership, both from the private community as well as the governmental community.
Excellent. Just out of curiosity, down here in South Florida, they televise zoning hearings
They do, and if you'd like to tune in to any of my zoning hearings,
Well,
yes, they do, and I'm glad you mentioned that because it triggered something. I think it was maybe Mickey Mantle that said, for baseball, hit the ball where they ain't, meaning the fielders. One of the things that I look at, and maybe some of you do, maybe some of you don't, there's plenty of services that say they compile things into one fantastic piece of proprietary software. But I happen to be one of those tweeners where I started my practice, let's say the old days where we used books, and now, with all these fancy, software, so to speak. And in doing so, I look at agendas from every city. I do work throughout the state, primarily in this South Florida area because this is what the burgeoning area is. But look at agendas, listen to the mayor that you just heard who said what is going to transpire, and follow what the trends are in the city from what you might hear on Miami Beach Television 77. That's how you find them.
A quick story, and then we'll go to Travis on it, and I'm sure he's probably done this. When I was a young broker, I happened to run into a land use zoning attorney who went to law school actually with my wife, and they were friends. And he said, and I was probably in my 20s at the time, and he said, you need to come to zoning hearings. And I'm like, why do I need to come to zoning hearings? And after I went to my first zoning hearing, and I met you, and I met you, and I met you, and I was the only real estate broker in the room because no one wanted to go to zoning hearings, believe me. It was an early indicator, as you said, and I'm sure both Patrick and Travis have probably been in many zoning hearings. But let's move to what one of your specialties, certainly, but one of your diversified businesses is self-storage, and so certainly that comes with all sorts of things. And I'll also add, I pay $325 a month for my 10 by 10
Thank you very much.
in northern New Jersey.
We appreciate it.
And that is actually less than the $700 a month I would have paid if I had it in Manhattan. So if you want to, when you start thinking the economics of self-storage, it's wonderful. But
Absolutely.
Yeah.
Well, look, the issue with self-storage is it's just not a sexy business. It is a business that happens to be categorized as a real estate asset. And if you're really thinking about, turning the conversation back to why be in tertiary markets, one is because of the diversification and the risk mitigation that comes along with those kinds of markets. Two is it's just more affordable. I can go up to Port St. Lucie, I can go up to Vieira, I can go up to Melbourne, and I can find an asset that kind of fits what we're looking for at the price point that we want to pay for it. Three, we don't have to worry about the big competition. We're not worried about public storage and extra space and CubeSmart, the big REITs coming up there, because that's just not a big enough demographic for them to move the needle at the end of the day. And there's reduced regulatory, as Dave said. We don't, we go to a zoning meeting and we get the skinny right there, and then we're able to go out and execute. So we don't have to jump through a lot of the bells and whistles. And then our strategy is a value-add strategy. In those markets, we are able to execute our value-add strategy more efficiently and more effectively. So we like dealing with the legacy self-storage owners, the mom and pops per se, and we have a value-add strategy where we go in, we acquire these assets. We love talking about 1031 exchanges and DSTs and REITs and things like that because we get those, and cost segregation is one of our favorite words. Those are the kind of strategies that we deploy, right? We're going to go in, we're going to look at the asset, we're going to automate the asset, right? We want automation to happen. Two, we're going to utilize cost segregation on the asset. Three, we're going to mandate something like a tenant insurance, right? That we deal with lien law, which means we manage stuff, right? Versus tenant law in multifamily means you manage people. I like every last person in here, but I really don't like people that much. And so we really try to function in that area, put together a large portfolio, and then have the big REITs come out and kind of take us out, or private equity, which is piling into the market. And we're doing it in those areas because we don't have to fight with the big REITs. We don't have the resources or the manpower to be able to do that. So looking for those limited partners to come and who want to take advantage of that.
Excellent. So we can get back a little bit on time. This will be our last question. You heard a lot this morning from the Fed. You heard a lot from the mayor. Even I made some projections and gave some aspects of where things are going. So from your own business and personal point of view, how do you see commercial real estate, whether it's in your niche or in general, over, let's say, the next 6 months to 2 years? Patrick, we'll start with you. I know it's a hard question, but everyone has an
How much
opinion.
time do we have?
We have about 2 minutes.
All right. So the question is, how do we see it? What's happening over the next 6 months to 2 years? That's,
Yeah.
I think the question. So
Your point of view.
I think from our point of view, we're kind of the first guy in, right? We're a developer. We're on the edge of the growth for the most part. We're trying to bring goods and services to new communities that are out there, right? So for the next 6 months to 2 years, I think in the short term, we're all going to go through a reevaluation period. What are these assets worth, and how do these numbers work, right? There's a lot of people, especially in my shop, my guys are running a lot of pro formas and doing a lot of math right now, and we're trying to answer that question. What is this really worth? And I think from our perspective, there's what is it really worth today so that we can buy at the right price 6 months from now, 2 months from now? And then the other part of that question is, if we do make that informed decision to go ahead with a project today, what is it worth 2 years from now, right? We heard the Fed speak. We think, interest rates are going to stay the same for longer, right? It's not going to come down. So in our business, our main buyer of our assets is a 1031 exchange buyer, right? And the real question is, if rates remain the same, what happens to our asset 2 years from now, right? Is that asset going to trade at a 4.5 cap? Everybody in this room is going, no way, right? But is it a 7 cap? We don't know that, because what we don't know is,
You developing a Chick-fil-A's?
yes.
They still kind of, but that's a whole other story too.
So the question is really, what is our prospect 2 years from now on the exit? And part of the discussion that we're having is, do we just keep it and collect the return? Utilize some of the strategies that we just heard about to create the profit that we normally have created over the past dozen years, where interest rates were effectively zero and money was flowing. Now we're trying to understand, if we put capital into the market, what's our prospect for getting that back? Are we going to hit our 2 multiple? Are we going to hit our 3 multiple? Are we not going to hit a multiple? And what kind of cash flow is that asset going to create? One of the things that we're very interested in today is, what does that deal look like 2 years from now, and what is the cash flow that's created? Whereas a year ago, 2 years ago, we weren't really worried about that at all. What we were worried about is, can we find the right exchange buyer at a 4.5 cap to take us out? So our business model has changed dramatically over the last 6 months. Our product has not, and I think the flight to quality of that product is going to keep those cap rates a little compressed for a little bit longer. But the real question, and I'm not sure anybody knows, and if you do, please come find me after, is, what is that exchange rate going to be? What is that cap rate going to be 2 years from now?
Excellent. Travis?
Well, I think I hate to be the pessimist in the room, but I think there's a little more pain ahead. I truly do. The numbers look good from what the Federal Reserve is saying right now, but I just can't see us turning the corner that fast. So I would certainly say, in the next 6 to 12 months, be conservative, pay attention. I don't think rates are going to move down anytime soon. I still think that's 18 to 24 months away before we start to see any type of movement in a downward movement. So that's kind of my 2 cents on that.
All right, David?
Well, I'll try to be the optimist then, but because I was going to be the pessimist, but I agree with everything both Travis and Patrick said. For what I do, I like to look at properties individual on behalf of my clients to see, well, what opportunities are there that everyone else had missed? Is the property contaminated? Then you can put the property into a brownfield. You don't have to necessarily develop that. You can hold that for a while. Certainly there's carrying costs associated with it, but it depends upon where that property is. And I'm not just talking about brownfields, there's other I'll say it again, responsible legislation, grants, anything that would allow your return on investment to be higher than what's otherwise expected based upon the macroeconomy. I wouldn't call it a microeconomy. I would just say that in looking individually, city by city, municipality by municipality, there are advantages. They're just a little bit harder to see because we hear about what's happening on interest rates. I think the woman who spoke from the Federal Reserve earlier said, are they up, are they down? We don't know. That's Patrick's point. But what we do know is that there are, I'll say it for the fourth time, my God, forgive me, responsible legislation that we can take advantage of.
Say it a fifth time, because statistics show that you have to say things 5 times for anyone to actually...
I was going to bang my shoe
Okay.
on the table like Nikita Khrushchev did at the UN, but no, I said it 4 or 5 times. But everyone here, I think it's worth the while to look a little bit deeper into properties, into areas, to look at the comprehensive development master plans of different cities, to engage with politicians. Because it's a win-win. They like to be a partnership with you. If you're either holding property now or looking to expand to the South Florida market, because it's a hot market. There's no taking away from that, notwithstanding the interest rates. But I'll stop there. It depends upon where you're buying.
How about a big round of applause for this panel?
Thank you.
Sorry.